Hello and welcome to Revision Tips for SIPS Level 6 Professional Diploma in Procurement and Supply. This is Module 6, which is Strategic Programme Leadership. This module is going to help you to be able to assess the contracting requirements and approaches to the leadership of major strategic programmes and evaluate the role that the organisational culture has to play in achieving overall success. So procurement typically refers to the process of obtaining products or services for a specific use or intention. In some organisations, procurement is devoted to the supply function. It's centralised or has very specialist departments. Some organisations refer to contracting specifically for the purchase of services, while the purchase of products from a supplier is called procurement. But in industries that are characterised by large expenditure to medium and long-term timeframes, especially in the construction industry, the role of procurement goes way beyond purchasing, and this is sometimes known as the procurement route, a particular procurement strategy that's regarding the design and delivery of a product or service that can be procured. So of course, there are a variety of procurement routes available to organisations to choose from. You know, the intermediate resources of any organisation will heavily influence the procurement routes. And I suppose it's about the long-term aspirations as well of that contracting programme. So for the purposes of this module, the term contracting is used specifically to refer to a supply management activity. So we've also got kind of client coordinated approaches to major projects as well. So projects are a specific activity with clear deliverables, distinctive start and end dates, whereas a programme is a coordinated group of multiple projects which together deliver benefits to the organisation and any ongoing organisational operation. So the key aspects of both project and programme management and the skill sets required to manage projects and programmes will extensively overlap. But the primary difference between a project manager and a programme manager is that the latter has a more holistic view and is concerned with the alignment of all the projects to a strategic goal and objective, whereas the project manager focuses on the delivery of a specific project. Now, major projects relate specifically to large-scale endeavours, and it could be focused on infrastructure and require a significant investment. It could even be an investment in a new IT system, the construction of a new production plant, or a building, someone's headquarters. But essentially, it's a commitment to a large-scale project. And there are three things that set a major project apart from a normal project. Firstly, it's the purpose. A decision to invest in a major project will be based on long-term projections and based on infrastructure requirements of the organisation. Then the scale, the decision to invest in a major project will require significant investment beyond what would be considered normal day-to-day budgets. And the outcomes, a major project will by its very nature be transformational in regards to the impact its successful delivery will have on the way that the organisation does business. The relationship between major project partners are shifting and moving to a more pluralist perspective where different parties are coming together to work efficiently. And you'll have cross-disciplines and cross-functional teams working remotely, but they do create a collaborative environment where diverse perspectives can be explored. The outcome of the relationship is well managed, it will increase flexibility and commitment to the project goals. But here we can see how traditional procurement and supply relationship approaches have progressed from what was traditionally a transactional approach all the way through to a value chain orientation found in more contemporary relationships. So the stage one was this transactional orientation. It was about, serving the factory. The relationship was based on raw materials, components, and no coordination. It lacked any explicit purchasing strategy, and the goal was very primitive. Relationships were reactive and strongly focused on administrative tasks. The second stage was the commercial one, looking at the lowest unit price. So procurement here tended to be a standalone function where the relationship with suppliers was a bit more proactive, but it's about aiming to achieve a lower price for the organisation and monitoring savings and performance. The third stage is coordinated purchasing, where procurement and supply is centralised, operating under uniform policies, clear purchasing processes and systems that focus on cross-unit coordination and compliance with their negotiated agreements. And as a result, the procurement and supply function is often a little bit more bureaucratic and slow to respond, but it's beginning to start to attract attention from the senior managers, and external relationships continue to be focused on a strong commercial deal. At stage 4, you've now got internal integration and some cross-functional purchasing here, where the relationships on the supply chain become more integrated and focused on cross-functional problem solving to contribute towards cost reduction. So procurement will interact with supply partners and do joint problem solving, streamlining processes just to meet the needs of the customer. And stage 5, we're getting onto external integration here with the supply chain management. So this results in outsourcing strategies that are developed with cooperation from supply chain partners, including product development and pre-production planning. The systems are simplified, utilising technological capabilities and enhanced by interdivisional and inter-organisational cross-functional teams. And then the final stage, number 6, is the value chain orientation. And here you see recognition that procurement and supply strategies need to deliver value to the end customer. So you see strong relationships. They're being encouraged with suppliers, being challenged to support and participate in product development to design an effective and an efficient value chain. Now, contemporary organisations have, contended with complex and fast-changing pressures from the external environment, but for performance to remain stable, the procurement professional needs to consider how to adapt the relationship with contracting partners to identify these critical pathways to project success. It goes beyond simply setting objectives for suppliers and setting requirements for project tasks. So EPC contracts. EPC is engineering, procurement and construction. An EPC contract is used in cases where the client wishes to extend their facilities, but don't really have the expertise to do the task or perform the works that are needed. It could be the client deems the programme to have a level of risk associated with it, which would be better handled by a party with more experience. It could be constructing facilities with which they will then used to conduct processes for infrastructural purposes like building a power plant, a prison, or a manufacturing facility. The EPC contractor's job will include being responsible for the delivery of the project from commencement to final completion. They may engage other consultants, suppliers, or subcontractors to complete the programme, but they retain the responsibility to the client for delivering the programme. They'll use traditional project management techniques to break the contract down into key phases and milestones like mechanical completion, performance testing, provisional acceptance, and commercial operation. So let's look at these milestones in a little bit more detail. Now, given the size and complexity of projects, to make use of an EPC arrangement will generally utilise traditional project management techniques to break down into key phases. So the milestones are firstly mechanical completion. That's representing the startup and commissioning of a system in the building where all systems and equipment are checked and calibrated by the client. Performance testing is a milestone given to the EPC contractor. It gives them an opportunity to demonstrate that the building is suitable for the requirements of the client and it meets the performance guarantees which were agreed. So this will involve operating the facility at maximum capacity within normal working practices over a short period of time. So for example, in the construction of a power plant facility, the power plant may operate under full capacity while measures of key metrics are taken. And on the bathtub on the right-hand side, this is essentially It's utilised in reliability engineering. The bathtub represents there are 3 categories of failure: either early failure, which will decrease over time to be replaced with this constant failure rate resulting from random failures. And the final category is described as a sort of wear out failure as the product life expectancy is exceeded. Moving on to provisional acceptance, during the performance test of the facility, there'll be some scope for the provision of leniency against the agreed performance criteria. This may be accepted by the client on a provisional basis, so the contractor is not liable for any liquidated damages or delays, but the contractor remains responsible for the finding of a remedy of any deviation from the agreed performance within a specific time frame. And then commercial operation focuses on provisional acceptance when the results and analysis of the data from any performance testing is complete and verified. That could take some time as a result of needing to be checked by the client and an independent engineer. But during this time, the EPC contractor remains in control of the care and responsibility of the facility. And on acceptance of that responsibility, the ownership transfers to the client and the commercial operation of the facility now commences. So, EPC contractors assume sole responsibility for the risk and completion of the programme, but other distinguishing features of an EPC arrangement are shown on this slide. So what we're saying here is that, EPC contracts can have, fixed price contracts. Any cost saving or deficits incurred during that programme will lie with the EPC contractor. A fixed completion date, they agree to work up to an agreed date. In addition, in a similar vein to the price, the end date may be extended, but only by agreement with specific circumstances. Limited contractor claims, due to the very nature of EPC contracts, which pass all risk and responsibility to the EPC contractor, the scope under which they can make claims for additional funds or remedies is really limited. But it doesn't exclude the client from any liability as a result of them defaulting on its obligations or any force majeure or anything like that. And the last bit in terms of limits of liability, due to the common use of EPC arrangements for the construction of large infrastructure projects, there are likely to be large financial implications if the programme is delayed or a deficit arises. So as such, the EPC contractor will usually seek to limit or cap the total amount for which they will be liable for as a measure to protect themselves against going bankrupt from a single programme. So there are obviously a lot of advantages to the contractor and to the client. I mean, from a client perspective, the allocation of design and construction risk is to the EPC contractor. Easier for them to program manage because there's only one contractor to liaise with. There is certainty of price and budget, and arguably the completion time will be quicker because of the incentive. And the project delivers, or will typically deliver, something that's fit for purpose through the use of a performance specification. From a contractor's perspective, there is more control over the design and selection of the subcontractors. Potentially, the contract price may be more lucrative if early completion targets are met. The scope is clearly defined, which allows more detailed planning and fewer changes. And only one point of contact with the client prevents any confusion with the subcontractors. So the use of EPC arrangements is likely to continue to grow, especially in the construction industry, due to the need of a project delivery method which can fulfill the owner's requirements in budget and on time. So EPC serves the purpose better than any other contracting model, so its dominance can be expected in construction industry for the long term. But despite the numerous advantages of the EPC contract arrangement, in order for the advantages to be fully realised, there are a number of good practice that should be observed. Timeliness, procurement and supplies need to be well timed and coordinated. If they arrive late, it will cause delays to the programme. If they're procured too early, it might require long-term storage, and that can cause a lot of inconvenience to the contractors. Communication needs to be very clear and consistent between the functions and the stakeholders. Any schedule change or delay needs to be addressed in a manner while making status reports available and key performance indicators readily available. Cost management, good cost control is really necessary to ensure that the programme is completed within budget and time frame outlined as a start. Given the scope and size of the EPC contracts, the cost can easily spiral out of control. Detailed records should be kept and checked to ensure this does not occur. Some studies reveal that up to 14% of programme total cost can be attributed to parts of a programme which have been overrun in terms of costs of, and maybe material costs have been wasted as well. And then quality control, continual emphasis on quality is made to ensure that the client needs are met, and that could lead to the adoption of total quality management or a similar philosophy. We're now going to look at management contracting and construction management. A management contractor, the contractor appointed by the client for the completion of a programme, and they act as something called a principal, whereas a works contractor is a subcontractor that's engaged by the management contractor on a programme. So you can kind of see how that relationship works on the right-hand side. So a management contractor is engaged early in the design process. It's possible for some works contracted to be tendered at an early stage, meaning they're not dependent on the completion at later stages. This sometimes occurs before the entire design programme or process is completed, and that can result in early completion of the programme. On construction works, the work contractor may construct the foundation works or plying while the design of the building is being finalised. So a lot of that stuff can be basically done in parallel. So some noticeable features of the works contracts under management contracts is firstly certification. Each works contract must be certified once the work has been contracted or completed. This helps to provide a written record and evidence of when liability period should start and cannot be dependent on work which is outside the scope of the works contract. Scheduling measures, as the works contracts may be completed at different times by different works contractors, the management contractor will implement measures to prevent the programme from being unnecessarily delayed, and that subsequent work will be dependent on the completion of work under the contract. In terms of retention, generally works contracts include a retention amount or a bond, which acts as a guarantee of performance expressed in financial terms. So, for example, work may be completed and 80% of the invoice is payable. The remaining 20% will be paid once the work is deemed to be of an acceptable standard. And insurance, work contractors may be asked to provide professional indemnity insurance or liability in the event that, after commissioning the client, they can pass on any claims from the use of completed programs which can be attributed to a specific works contractor. So there are advantages of management contracting, but conversely, there are going to be disadvantages too. The advantages, I suppose, are that the overlapping of design and construction process could potentially make the program much quicker. The management contractor and the works contractor can contribute to the design and facilities and the planning. If the relevant works packages have yet to be tendered, then changes to the design can be accommodated quite easily. And works packages are awarded competitively at fixed prices that makes budgeting much easier. But the downside, of course, is that the actual cost of the programme is unlikely to be revealed until all work packages have been tendered. And the success of the programme relies on the management contractor's expertise and commitment. There's going to be a large reliance on specialist knowledge to ensure there are no gaps. And the individual warranty provisions that a client has with the works contractor can take the relationship or make the relationship between parties a little bit confusing at times. So management contracting is different to construction management. That involves management of contract arrangements relating to works directly, whereas construction management focuses on the administration and activities to trade contracts, which are placed with the client. So in essence, a management contract is a prime contractor, while a construction manager is an agent of the client. A construction manager is contracted to oversee the completion of a program as an agent of the client. That will include sort of preparation of certificates, administering the contracts, determining the required labour and materials needed to complete the program, and monitoring progress and checking the quality of work in the program along the way. Now, there are similar benefits, to the construction management. They share that with the managing contractor, but it's namely the overlapping process between design and construction that allows the project or program to be completed in a timely, efficient manner. But like management contracting, the final cost of the program is unlikely to be fully known until all work contracts have been agreed. So advantages: the overlapping, the quicker turnaround time. The construction manager and trade contracts can contribute to the design and planning. If the relevant trade packages haven't been tendered, then of course you can make changes. But everyone's roles and responsibility is quite clear, and the client has direct contact with the trade contractors. The downside is the actual cost is unlikely to be known until the program is fully tendered. The success relies on close controls and funds. The client needs a level of experience and expertise to cooperate effectively with the contractors, and the timely completion and delivery of the design phase it's basically really essential, because there's going to be a reliance on that expertise from the construction manager. So I'm now going to look at the sort of workflow plan. Both management contracting and construction management arrangements follow a very, very similar workflow plan, and there is a number of stages. Starting firstly with business justification, there has to be a kind of statement of need that outlines the requirements, and that needs to be supported by facts and evidence. And then a feasibility study, which looks in more detail at the options available to satisfy the client needs, and it allows the client to be a little bit more prepared. The project brief, this is the basis of design. When you create a project brief, the client and consultant teams discuss the content of that, which includes site information, spatial requirements, technical requirements, and also to identify the types of specialists and contractors that they would need to engage during the program. The concept design is next. At this point, the initial idea for the facility has been proposed, but it considers functionality, so the final design satisfies the need of the client. And then you appoint your management contractor or your construction manager. And you can do that through some sort of competitive process, or maybe accessing an existing arrangement or a framework. The production information at this stage, you'll need to perform an activity around, getting applications for approvals, permissions, building regs, but also ensuring that the work can commence. So there'll be quite a lot of information you need to put into place here before you can go on to the tender works contracts. Because at this point, you need to be scheduling, for finalising information before the contracts can be released. Mobilisation, this is looking at sort of getting everything ready. So you've appointed your contractor and you now have a sort of on-site date in mind, but the mobilisation period will be getting everything ready, agreeing the programme, handbook, etc. The construction phase, at this point, of course, the work is starting to commence. You'll have different construction periods, performance and completion certificates being issued after each work package. And the management contractor or the construction manager is responsible for all the scheduling and supervising. Occupation and defect liability period, after the client has kind of taken possession and responsibility of the facility, it's essential that close cooperation is maintained between the client and the management contractor. So any defects will become apparent and can be rectified. And then there's a post-occupancy evaluation. The final phase involves the determination of how successful the programme will be in terms of, the iron triangle, which is usually based on cost, quality and time, CQT. And that's a valuable stage for organisation and contractors who are involved in similar programmes, because, lessons learned can help you to improve in the future for similar scenarios. Okay, DBO contracts are next. This is design, build and operate contracts. Now, in this situation, the contractor is responsible for the design and build activities, as well as the operation and maintenance of the completed work or facility. This reduces the number of external parties that the client has to deal with, and typically it's used for programs with durations of 15 to 20 years or more. So it does support that kind of long-term relationship. It encourages the contractor to design and build a facility which is durable and reliable, efficient to operate, but also encourages high levels of innovation, cost efficiency, and performance delivery. The contractor can take an integrated approach to the programme and plan for the activities to overlap, which clearly reduces the completion time for the programme and leads to greater cost efficiency. You can include provisions for replacement of assets or components that will fail due to wear and tear, or to reach the end of their useful life if it falls within the time frame of the programme's contract. So from an advantages perspective, the client only deals with one point of contact, which is great. Degree of certainty of price, which makes budgeting much easier. Overlapping activities reduces completion time, and the contractor can take an integrated approach. But the downside is comparisons of the bids will be really difficult because the design requires different prices and different timescales. And there is no evaluation of the final design unless the client contracts an independent team. If there is a change to the requirements during the programme, it can result in expensive amendments. And if costs are given primary focus, the final design of the facility may not be visually appealing or functionable. So let's now move on to public and private partnerships, which was called PPP, now P3, which is a cooperative-based contract between government agencies and a private sector company to finance, build and operate an infrastructure asset. So the public partner essentially uses the expertise and skills of the private partner to perform either all or significant aspects of the programme, such as financing, design, construction, operating and maintenance. The risk and reward of the programme are shared between the partners, giving them the incentive to cooperate and see the programme fall through to a successful operational phase. But the key factors that you would need to consider is, what's the level of capital investment required for this programme, and can the public partner afford to surrender the revenue that it would receive for operating the programme after completion? What's the technical requirements? What kind of operational controls and measures would they need to put in place to determine whether the programme is being properly serviced? And one of the key detriments of deciding whether to use a PPP contract is the use of the value for money analysis, which was typically the 3 E's: economy, efficiency, effectiveness. But now there's the fourth one, which is about equity. And value for money is the optimal use of resources to achieve an intended outcome. It's measured in a number of ways. Economy is about minimizing its financial resources. Efficiency is about the relationship between the resources that are needed and the output. Effectiveness, the relationship between the intended purpose and the actual result. And equity is the extent to which services are available to reach all the intended users fairly. So there are advantages and disadvantages, both for the public partner and the private partner. So from an advantages perspective, from the public sector side of view, they kind of transfer the risk. It allows for projects to begin much sooner than them having the money to invest. Sometimes the quality is higher. Risks and project feasibilities are likely to come under more scrutiny, and reported that the use of PPPs reduce government budgets and deficits. From a private sector perspective, the financial risk is shared with the public sector, potentially more lucrative in the long run. The public partner may agree to pay a minimum fee during the lifespan, and early completion bonuses may be available. But don't forget, there's a lot of environmental factors that you need to consider in a PPP contract. So anything from the steeple framework, social, technological, ethical, and so on and so forth. The downside to the public sector is higher financing costs associated with the programme. So that will secure lower interest rates through tax exemptions, loss of control over the operation of the asset, and they forfeit any future operating revenue and potentially have higher fees resulting from asset monetarised PPP. But the downside from a private partner is constant monitoring and ordering privileges to the public partner, high initial outlay financially, and solid financial planning is needed. And there could be restrictions imposed on fee increases, so it's not to deprive or exclude users from the use of that developed infrastructure asset. And this slide here is just showing you a summary of the key features of those 4 options: the EPC, the management contracting, the design, build and operate, and the public-private partnership. If you want, perhaps it's a point to now pause and just consider the additional features from accountability, risk, procurement, quality, client involvement, and defect responsibility. So we're now moving on to 1.2. In many professions, there exists at least one professional body or institution which is recognised in a given field of work. Institutions aim to develop the interests and practices of individuals associated with the relevant profession and ultimately look to safeguard the public interest. So the accreditations by institutions and firms demonstrate how they operate to a defined standard which provides trust and peace of mind for the client. Functions of a professional body or institute include setting standards for best practice in their industry, addressing technical and ethical aspects of an industry in order to build both social and economic capital. Member engagement, education and training, international membership and connections, which promotes industry recognition, legal and governance, policy, research and knowledge, as well as others about how to host awards and events to raise the profile of the profession. But in the UK, there are approximately 400 professional bodies which represent approximately 30 million working professionals. And these are divided into professional associations, regulation bodies, and learned societies. But some professional bodies combine these functions, and we've got, the Chartered Institute of Procurement, New Engineering Contracts, International Federation of Consulting Engineers, Institute of Mechanical Engineers, and the Joint Contracts Tribunal. So let's start by looking at the New Engineering Contracts. The NEC, that's what we call it. The NEC Contracts is a typical system of contracts which is designed with the intention of being flexible enough to cater for a variety of scenarios, yet specific enough to achieve specific aims. And this was developed by the UK's Institute of Civil Engineers, the first version being released in 1993, but the most current version is something called NEC 4, which was released in 2017. Now, the intention of NEC contract is to create a collaborative relationship between the contractor and the client, and it's facilitated by a flexible approach to the contracting system. So essentially, it's attempting to address the most adversarial relationships of typical contracting arrangements that could arise, where the allocation of liability is a key focus of contract discussions. And this is achieved by addressing clarity, flexibility, and stimulus to good management. So from a clarity perspective, contracts should be written in simple English in the present tense without any legal jargon or ambiguous terminology, such as variation or reasonability. Bullet points are frequently used to keep the structure simple and to the point. From a flexibility perspective, that's one of the key features of an NEC contract. the flexibility of terms in situations which can be used. So, for example, for both professional services and supply contracts, the main contract of an NEC allows a range of payment options to be used, such as lump sums, target price, reimbursable. And then the stimulus to good management is because NEC contracts are drafted as processes and mapped out using flowcharts. They give common understanding to all parties involved in improving the performance of a programme. With this, the roles of the parties are clearly defined, and the timescales and any effects resulting from change in the terms of the timescales and finances are assessed in advance. So here are the 9 clauses included in a standard form contract. You've got the general terms, which provides defined terms and provides clarity regarding any explicit interpretation. The contractor's main responsibilities outlines the provision of work that they will be completing, which will include the design, labour, and any areas where a subcontractor might be employed. The time frame provides a schedule of work, including the start date, completion date, key project dates, programme access and handover. Quality will talk about the testing and inspection process, who's responsible for undertaking any defect corrections. Payment provides an assessment of the contracted amount, could be a gain share, pain share mechanism. And compensation events are events that prevent the contractor from completing the work or delay, which neither party could prevent. So it's judged as being a low risk of occurring, but when it does, there's an option within the NEC contract to allow for it. The rights to materials outlines what title of plant and materials will pass to the client and at what point. Indemnity and insurance are the obligations in terms of providing insurance for loss and damage for works, plant, materials, equipment, and property. So the contractor and client will need to indemnify each other against any claims that arise from an event that is at the client or contractor's risk. And finally, termination. Both parties have the right to terminate the agreement, although the contractor may give a reason, whereas the client can terminate at their discretion. And this is just a suite of contracts. You know, you've got anything from kind of works contracts, service contracts, and supply contracts. The works ones tend to be engineering and construction. Some of them are short form, and any sort of subcontracting ones. The services ones can be sort of framework contracts, term services, professional service contracts. And then the supply contracts are simply where you're asking for sort of bespoke big items or something along those lines. So in terms of the pricing, there are a few pricing options that are available in an NEC contract. And what this is showing you here is the balance of risk between the employer, who is the client, and the contractor. So you've got an option A, which is a price contract with an activity schedule. So a lump sum is set for the works. That may change if there's a variation in the works resulting in a compensation event. Or an option B, again, is a price contract, but they've got a bill of quantities attached to it. D and E are, C and D, I beg your pardon, are target cost priced contracts. So both have a target cost, but C has an activity schedule and D has a bill of quantities. Option E is a cost reimbursable contract. So parties agree the level of the contractor's overhead and profit, and the client pays the actual cost for the work. And option F is for a management contract. So it doesn't distinguish between construction management and the management of contracting. All right, let's go on to the FIDIC now. This is the International Federation of Consulting Engineers. So FIDIC is a French language acronym for the Federation of International, I can't pronounce it actually, but it's the, in French I can't pronounce it, but it's the International Federation of Consulting Engineers. Do you know what? This was established all the way back in 1913, and its headquarters are actually in Switzerland, but they have members from over 90 countries. So it's quite, you know, it's quite out there as a sort of, you know, well-known model form contract. One of the activities is to produce and revise as necessary a standard form of contracts for the construction and engineering sector. So although FIDIC contract forms cover a wide range of program types, there are some common features among them. So the first is the contract form, typically divided into two parts. Part one is made up of the general conditions, the rights, the obligations, the payment process, and the dispute resolution, whereas part two is the conditions which relate specifically to the program. So you'll have things like, the contract agreement, the letter of acceptance, the letter of the tender, and any particulars around that application. The resolution process is next. They use a multi-step resolution process with the emphasis being on reaching settlement of any dispute in an amicable manner. So the first step of the process is resolved by something called adjudication, where an adjudicator's decision is temporarily binding until final determined by settlement, litigation, or arbitration. If the resolution resulting from adjudication is not satisfactory, then there's an agreed time where you can reach an amicable settlement. But if no agreement is made, then the final stage of this process is arbitration, which is where an independent third party is appointed by the contracting parties to make a binding decision that will settle a dispute between those parties. And that's usually in accordance with the rules outlined by the International Chamber of Commerce. And the final point is about English law bias. There's a bias in a FIDIC contract to favour principles of English law, as this was the basis of contracts that were first, when they were first established. So, for example, provision relating to liquidated damages and the interpretation of penalties typically practiced by English law. While at first glance, the FIDIC contracts seem really complex and daunting, the comprehensive nature of the contract form encourages the parties to engage in more in-depth discussions and negotiations that cover all major elements of the contract. So there's basically not very little ambiguity left. And it could be argued as well that you can reduce costs, because once you know what's in it, you don't have to keep retraining. It's sort of knowledge that passes through. Now we're going to look at the Institution of Mechanical Engineers contract forms. They're based in London and look to further the interests of any mechanical engineers and the profession as a whole. It represents the interests of 120,000 members over 140 countries. And it does work in a variety of industries, from sort of aerospace to energy to manufacturing. And they've developed their own model form contracts where expertise for mechanical and electrical specialists need to be used on programs involving construction. There are currently 7 primary publications which are comprised of 4 model form contracts. And then the other 3 are basically a company commentary or guidance notes. So the first one is MF1. This is a lump sum contract for design, supply, installation and performance testing of any electrical, electronic or mechanical works. So the work is to be handed over on a specific date and needs to be met by defined performance criteria. So you typically see this as a results-based contract rather than a works-based contract. The MF2 is a lump sum contract for the supply of electrical, electronic and mechanical works. MF3, a lump sum contract for the supply, including the sourcing and delivery of electrical or mechanical goods in the UK only. And then MF4 is a consultancy agreement, which is made up of a short form agreement and a set of terms and conditions. Its intention is to formalise the appointment of a consultant for the use on an engineering programme. So the IMEC form contract is used for specific electrical and mechanical works, and they're needed for the supplier installation on a construction or an engineering programme. But the choice of the contract will clearly depend on the type of work that's needed. We're now going to move on to JCT, which stands for Joint Contracting Tribunal. This is from the Royal Institute of British Architects and the National Federation of Building Trade Employers. They formed the JCT back in 1939, and over the time, different organisations have joined. So it's now got sort of 7 members representing a wide range of interests from building and construction sectors, such as British Property Federation, Contractors Legal Group, Local Government Association, the National Specialist Contract Council, the Royal Institute of British Architects and the Royal Institute of Chartered Surveyors, and the Scottish Building Contracts Committee. So each of these 7 organisations appoints a director of the board to represent its interest. And the actual council itself is made up of 47 representatives. So they're there to kind of maintain and produce standard forms of contracts. I mean, a lot of these things are designed to be sort of fair to both parties and written in language that's relevant to that particular industry. So a lot of the time they use the word employer. The employer is the client. And that's a kind of common, typical word you would see in some of these model form contracts. This slide shows you the kind of suite of contracts from 2011. The SBC is the standard building contracts, and there are quite a few of them actually. You've got ones with approximate quantities, with quantities, or even without quantities. You've got design and builds and intermediary, minor works, frameworks. There are so many different types. Essentially, it's like an off-the-shelf solution. You pick the one that's relevant and is going to help you to achieve the outcome that you're looking for. But they have a standard format, and it consists of like the articles of agreement, the contract particulars, the conditions of contract, and any schedules. And these schedules in the contract cover typical details, such as the specific program, insurance options, the fluctuations and design submission procedures. But the main clauses are similar to those that we found in the NEC. So you've got things like definitions, how to carry out and control the works, payment, variations, and so on. So there are some sort of additional roles that the contract administrator would have if you were administering a JCT contract. They would be there to oversee change orders and variations. So these changes result in the change in the price, or the contract administrator is responsible for ensuring that any changes are correctly charged. So it sort of works very similar to an audit. Defective workmanship, that's the other thing. It states that, the administrator would be responsible for, making sure that they check every evidence and test the work has been carried out up to a point and rectify anything that's below the standard. And then ensuring adequate and timely flow of information. It is the responsibility of the contract administrator to provide the contractor with the contract documents, drawings, and work schedules. So in terms of comparing any contractual terms and schedules, the complexity of contracts will differ depending on the industry. And some of the key considerations when choosing which contract form you should use would be, firstly, the composition of the team. This helps the parties to understand their roles and responsibilities and where the risks of the programme are allocated. The level of client involvement, and whether a third party such as a project manager, a contract administrator, or a consultant engineer will be used. The compatibility of agreements, ensuring there is consistency in the documents which are called up in the contract form. The amount of information available at the tender stage, and the desired relationship between the parties. So for example, NEC contracts focus on collaborative working relationships, whereas JCT contracts facilitate a more transactional relationship between parties. The cultural sensitivities and the interests of stakeholders. So for NEC contracts, they have proven very effective when the key measure is timeliness for completion. And FIDIC suites are more appropriate if the key measure is cost control. So the success of the programme begins with the choice of the contract form that's going to be used. We're now going to look at sort of different types of pricing mechanisms. So we're going to start with fixed lump pricing first. The method of the contract pricing or program will to some extent be dependent on the industry. So fixed price or lump sum contracts in the construction industry are quite common. And it'd be on programs which involve the use of lump sum fixed price contracts where you agree to do all that work with a fee that you agree up front at the very, very beginning. So a single price which the contractor offers to perform the works required. But in implementing this, the price may change based on the features which are selected by the client, but the final price may be dependent on optional features. So that's the feature dependent pricing. So for example, it could be when you're buying a new car, the basic model will include the advertised price, but if you want these extra bits, then you might have to pay for those bits on top. The customer segment dependent pricing, this is sometimes known as price discrimination. It means that price charged for the program might change depending on the customer. So for example, Microsoft charge prices for its Office packages depending on whether you're a personal user, a business user, or education user. Volume dependent pricing is where the unit price changes based on the quantity purchased. Typically, the more units purchased, the cheaper the unit price is. This is because of economies of scale. Now, although the pricing arrangement on lump sum contracts appears quite simple, in reality, there's often some flexibility built in. So examples could be any variations that have been requested by the client. So if they've asked for something above and beyond, they communicate this to the contractor on the basis that the program would have been costed at lump sum prices. Therefore, it's reasonable to allow the price to change in accordance with a variation requested by the client. It could be because of relevant events, that can lead to additional costs and expenses. So for example, when the contractor expects to receive timely instructions from the client, or the use of equipment provided from them is forced to wait or finds an alternative, this might incur additional costs. Provisional sums, these could be identified in the contract, and it makes allowances for specified elements of the work to be performed on the program. But such allowances are typically reserved for works where the details need to be confirmed during the program. And inflation, during long-term programs, which span many, many years, there is an inclusion in the contract which allows for changes in economic conditions because of inflation. And nominated subcontractors, payments may be requested by clients to a nominated subcontractor or a supplier to perform a specific element of work or provide materials. So the allowance for a price change will only be made if such a request by the client is made after the price has been agreed. Statutory fees, they may be payable during the course of the program. It could be things like planning applications, licensing, paying a utility provider to move a cable or a pipe or something like that. And allowable changes to price that are linked to fluctuations resulting from economic factors. Okay, so a typical example will be addressing any change that the client or the contractor has agreed to, but using a formula that will calculate those agreeable changes. So the next one we're going to look at is an activity schedule pricing. You can see an example of it on the right-hand side. In many contract forms for programs like NEC and FIDIC, the use of activity schedules appears quite frequently. So it's viewed as basically mini targets or steps to be taken to fulfill the overall requirement in a fixed lump sum contract. So the activities which are defined in the activity schedule usually relate to a scheduled payment. So the completion of this particular part would trigger the process for invoicing and payment. So they're staged payments basically, or interim payments. Bills of quantity, the pricing mechanism described so far largely involve contractor and a client agreeing a price for a program. But the use of bill of quantities as a pricing mechanism streamlines the process by making use of a cost consultant who provides specific measures or units of resources in accordance with the spec from the client. So typically measures are then provided that involve, quantities, dimensions, weights, and these prices build up. And the client issues the bill of quants for tender where potential contractors all have common baselines. And then we've got target costing, a pricing mechanism that encourages a contractor to work efficiently and offer them some sort of financial reward by working to a target cost. So this is agreed at the beginning of the project and then compared to the actual cost incurred. But if the actual cost is lower than the target cost, any saving is shared between the client and the contractor. But in the event that the actual cost is higher than the target price, any additional expense may also be shared, but in varying proportions as agreed in the contract. So the intention behind this methodology creates a shared risk-reward arrangement. And that encourages a high level of collaboration between contracting parties. Any such bonus payment or penalties are typically capped in order to prevent any adversarial behaviour. So a simple structure of a risk-reward mechanism would be 4% margin is fixed, target cost is based on benchmark, e.g. 12%, and underachievement of the target means a penalty of cost against the 4%. Overachievement means a set percentage of an additional saving awarded to the contractor. So target costs that are agreed between the client and contractor should aim to not exceed. And offering a financial reward if they work to a target cost can encourage contractors to work efficiently. Any saving is shared. That forces the contractor to focus on what the client actually wants, which is usually referenced to a specification or a statement of works, which in turn leads to a client having higher levels of satisfaction. Now, bonus payments and penalties are usually capped. Client must have sufficient level of experience and knowledge of the work to accurately estimate or negotiate with the contractor. And it is common in industries where there's a high level of completion and the end products are homogeneous or indistinguishable. And examples are construction, energy, and healthcare. So moving on to cost reimbursable contracts, there are times when the scope of works of a programme cannot be fully defined from the outset, and the risks associated with any work is really high. So in these instances, the costing of a programme might be based on an outline of a specification, any available plans, and cost estimates. So a cost reimbursable contract is one in which the contractor is reimbursed by the client for the actual costs which they've incurred during performance of the programme, plus an additional fee. So it could be a cost plus a percentage or a cost plus a fixed fee. Typical allowable costs will be like your direct labour, materials, any subcontractors, or any plant and machinery that's been hired. But the key types are the cost plus fixed fee. So the client reimburses the contract for all allowable cost, and then they add a fixed fee on top for their cost. The cost plus incentive fee is where you've got the allowable costs, they earn a profit based on performance levels, and the relationship between how much the contractor earns depends on the programme. And a cost plus award fee is very similar to cost plus incentive, but the bulk of the contractor's profit is based on broad subjective performance criteria. So using a cost reimbursable pricing mechanism requires a high level of trust between you and your contractor. And usually the costs are used for the basis of a contractor's accounting record. And they might even do like open book costing. So the final bit of this learning outcome 1 is, contrasting methods of investment appraisals for programs. And the purpose of this is to determine whether the contract under consideration is viable and provides an attractive proposition. Contracting authorities invariably negotiate contracts with a variety of clients, so it's necessary to ensure that the portfolio of contracts generates enough value to deliver sustainable benefits or business performance. So when conducting an investment appraisal, there are a number of practical points to consider. Only the relevant cost should be considered when conducting the analysis. And this obviously sounds really simple, but some decision makers may be tempted to amortize their fixed costs and overheads. And it's important that only the costs which change with the investment option are being considered. Opportunity cost of choosing one investment decision over another could also be taken into account. Any taxes that may be applicable to resulting profits should at least be considered, as it's arguable that the primary decision maker will be the most concerned with the post-tax returns. And even when programs which are costed on a tax exclusive basis, any return from the program resulting from cost savings or revenue generating programs will increase the overall corporate tax, which is payable at the end of the year. There's a requirement to understand the cash flow of the program. Cash flow rather than profit is really key. In the event that only data outlines profit flow, the cash flow will need to be derived or calculated, because it's really important that you've got the timings right. And when conducting investment appraisal, there's often an assumption that the cash inflows are made towards the end of the relevant month or year. But in reality, businesses will need to repay various commitments on a weekly or monthly basis, like wages, rents, and bills. And although this can be easily managed, it's a practical point which can be overlooked. And then when using the discounted cash flow techniques, it's important to remember that interest payments from loans or finances should be taken into account, even though it may not seem as a relevant cost on first impressions. And that's because the method of using discounted cash flows already takes into account the costs of any interest payments. And finally, the result of this should be used as part of a wider set of considerations and not the sole measure used to guide decision makers. So you might think of things like strategic fit for the program, company or volatility to a given market. And that's kind of hard to express in quantitative or numerical measures. So the methods of investment appraisal, we're going to look at sort of payback analysis first. So before a business undertakes a program, it's really important that they determine whether or not undertaking a program will be profitable and how long it will take for the company to realise the financial benefit. So payback analysis helps decision makers to assess the time it will take before the cost of the investment is recovered. So it's simply looking at the cost of investment divided by the annual cash flow. So there's an example here of 300,000 investment. They'll get 100,000 per year, so it will take 3 years for them to get a payback. And then we've got the average rate of return. In a similar manner to payback, the average rate of return allows decision makers to quickly compare options before starting or committing to a program. But instead of looking at the estimated cash flows and how quickly a program is likely to repay, the average rate of return looks at the actual return from similar programs in the past. So what that does is it allows decision makers to have some degree of confidence in the results obtained from using this method of analysis in terms of predictability and accuracy. So you've got the initial return divided by the initial cost, and then you divide that by a number of years times by 100. So in the example underneath, they got a return of 500,000 over 1.5 million initial cost. Looking at that over 5 years, it gave them a average rate of return of 6.67% per year. And there are discounted cash flows that you can look at, which is an investment appraisal method based on future cash flows and the time and value of money. But the choice of discount factor obviously needs to be taken with careful consideration. Now, a small change in the factor and number can result in quite a large variance in the valuation of a program or a company. Calculating net present values, one limitation of some of the investment appraisals is they don't really consider the value time of money or time value of money. And the challenge with this is that the decision makers are presented with several options and conduct an analysis of which one's more viable. So they're making decisions based on the present point in time for that current value of money. But NPV, or net present value, is the total over time of the net cash flows adjusted to allow for the time and value of that money over a number of years. Internal rate of return is a method to look at finding a yield or return for a program using discounted cash flows. And then obviously you've got the cash flow formula at the bottom. The net cash flow is the cash inflows minus the outflows. And that is the end of Learning Outcome 1. Thank you very much for watching.